Okay, joining us now is George Pearkes from Bespoke Investment Macro Strategist. It's a pleasure to have you, George. Welcome to the Market Huddle.
Hey, thanks for having me, y'all. It's nice to talk to some Canadians.
Nice.
The George, I was just having a look at your Twitter hit feed, and I noticed that you have something that I had to retweet because I thought it was just so kind of illustrative of what the current state of the market. You said that I have Evans, a Federal Reserve, board member. Evans down as the third most dovish non-governor and second most dovish non-governor voter. And he says that no more rate cuts are needed this year. Is the market completely out to lunch with the fact that they have October priced as an 85% chance for a rate cut?
Well, I actually think today we got evidence that the market is not out to lunch. And that came from Clarita, who is a governor. Clarita said, look, the Fed's going to act as appropriate to maintain the expansion. And that, to me, with markets pricing an 85% chance of a cut in October, they need to do more to push back against that if they don't intend to cut in October. And they know that, right? Like, they're not going to deliver an October surprise without grooming the markets for it first. So, Clarita saying act as appropriate, which is the same language that he's used this whole time through the easing cycle they've been on since the middle of the summer. That to me suggests that the market is right and that they're going to go ahead and cut in October. Although it is super interesting because, Evans did not sound like he was committed to a rate cut this week. He said, well, it would give us a chance to catch up on inflation, and that's good, but I'm also not super convinced about it. And he is one of the most dovish members of the FOMC. So, we've definitely seen some of the enthusiasm come out of the FOMC with regards to rate cuts, even though they probably will go again in October.
Do you think that the Federal Reserve was caught unaware with this repo kind of gate or whatever it is in terms of the fact that we had this spike in overnight rates and that they lost control of the front end of the curve?
Yeah, I mean, I don't want to oversell the fact that they did lose some control in the sense that, there was nothing they could do. It's akin to somebody who's been driving late at night on a freeway for a long time and it's dark out and the heater's blasting because you're in a cold Canadian winter and, you get a little dozy and you maybe start to nod off, but there are those rumble strips on the side of the road to wake you back up and then you're good and you can get your cup of coffee or take a break, probably is the safest thing to do, and sleep for a bit before getting back underway. And I think that's what happened with the Fed, right? They have the tools and they had the tools in September to deal with the repo crisis, to provide reserves to the market, make sure that there was enough liquidity out there. And they just didn't realize fast enough that they needed to get on that and do it. And I think part of that is on actually not the Federal Reserve in Washington, but on Williams, who is the president of the New York Fed, because he came in and there was some turnover in leadership on the market's desk. Simon Potter, who is the guy that had run that part of the New York Fed for a long time, basically was phased out and left the New York Fed or started to depart the New York Fed. And within, a month or 2 months of that announcement, you have the repo stuff blowing up. And so I think Williams sort of thought that he was in this cushy, high status new position and that he wasn't going to have to do much. And then all of a sudden he's got, real problems in the money markets to deal with. Nothing that the Fed can't handle, but it definitely reflects poorly on how he started his tenure as the New York Fed's president.
Wasn't there a little bit of egg on Williams' face in that he had to get Potter back for the FOMC board meeting?
Yeah, I'm not sure if he was the one that would have invited Potter or if the Federal Reserve Board in Washington would have been the ones that asked for him to come in. But I mean, he was absolutely the right person to be there to talk to them about what was going on, even though he had already at that point moved out of his role at the New York Fed. So yeah, tons of egg on Williams's face. And you never like to see people manage, relatively stable and competent institutions poorly. And that's sort of what looks like what happened with Williams.
Okay, so do we see a situation where we get a repeat of Christmas time when again they had some trouble with liquidity going into year end, or do you think that this kind of wake up call, the rumble strips as you so eloquently kind of described it, is going to make it so that they get out ahead of anything that might happen at Christmas time?
I think it's very unlikely we'll see a significant problem with liquidity around year end. So year end is always going to be tough in repo with the way the market, or with the way regulations and the way markets look at year end exposures. Really, it's regulatory that drives it more than anything else. There's just not that much balance sheet to go around. But with the Fed now talking about standing repo facilities, they're going to be buying bills to provide more reserves. They're going to have overnight and term repo around the year end period. They're aware that they need to be keeping a close eye on this, and that this isn't something that can just run in the background. I have a hard time believing that if we do see any major liquidity issues, that they're going to be something that lasts more than a few hours one morning before the New York Fed steps in with a bazooka and says, "Okay, guys, we'll provide the funding you need to get you through year end. This isn't going to be a problem. Everyone, calm down."
Okay, so George, you were actually one of the guys that first put me on to MMT. I actually reached out to you originally when I was confused by it and didn't know what it was, except for the stand for modern monetary theory. I was wondering what you felt in terms of the acceptance of this theory and the kind of change in attitude that you've seen over the last little while. I was wondering if you wanted to comment in terms of, do you think that it's becoming something that at the very least more and more kind of practitioners are looking at and trying to understand how a modern fiat-based kind of economy works?
Yeah, I mean, I think it's gotten a lot of attention from markets folks because it's a new and interesting idea in that respect. I mean, how much that's digging into the sort of body politic or the zeitgeist in the economics world is an open question. I mean, we had the Brookings Institution come out this week with a piece where they said, "Oh, millennials are super worried about climate, but they're not worried about the national debt. What can we do to fix this problem?" And it's like, guys, you don't get it, right? I mean, nobody who's got any sort of modern monetary perspective on how governments finance themselves, how government financing relates to the broader economy. Nobody would ever take that approach and say, okay, well, actually, government debt is a bigger problem in the United States or any part of the developed world. It's a bigger problem than climate change. I think we've definitely seen some uptake in some of the ideas surrounding MMT and some of the logic that underpins it, but we've still got a long way to go in terms of people understanding, the real core precepts of what's being said with modern monetary theory.
Do you think we're any closer in Europe?
Not really. I mean, look,
No?
like Germany's set to run what, a 2-ish% fiscal surplus this year, right? This is a country where national debt relative to GDP, which isn't a very good measure of debt sustainability, but is one people look at, that's going to be falling below 60% in short order. They've got major infrastructure issues, literally infrastructure crumbling around them. They've got no military to speak of. They've got room to ease their tax code significantly if they want to. There's all sorts of options in terms of what they can do to provide some fiscal stimulus, in the midst of a quite large shock to their manufacturing sector, courtesy mostly of European autos slowing down. And yet it's just not really something they appear like they want to do, right? And so, Germany obviously isn't the only country in Europe. Our friends, the Italians and French, don't mind deficits. But if, Merkel and co. aren't going to take a leadership role and say, what we need right now is stimulus, then it's hard for countries that are bound by Maastricht and bound by the European Union to ease their fiscal position significantly, and they're just not going to do it if places like the Netherlands, Austria, Germany, Northern Europe are worried badly about deficits when they have no rational basis for that fear.
Yeah, it's just fascinating because if you think about Germany, they're literally getting paid to invest in their infrastructure.
Yeah.
I'll give you one pushback because I've kind of felt the same way as you, George, that we haven't yet seen any sort of uptick in fiscal. And I was out for lunch with our prior guest, Aidan Garib from Pavilion Global Macro, and he actually gave me a chart that showed me the cyclically adjusted primary balance of European countries, and it actually looks like there might be a little more spending going on than we're seeing than we might believe. So maybe at the margin, we're getting a little bit more. And I notice as well that the Bund is kind of gone from that stupid level that we saw this summer and is actually now trading at only minus 35 basis points. Do you think that, 38 basis points as on the close. Do you think that that's just the market gyrating around, or you just don't think that we're at the stage where the Bund we might finally believe that that monetary madness is over?
Well, look, what the Bund does isn't purely a function of the fiscal position of the German government. So I think that's important to state right off, right? The
Right.
Bund yields can be making higher highs and higher lows, which they have over the past couple of months, without.
But there's no doubt if they keep trying to fix a problem with the slowing economy with easier and easier monetary policy, with tighter and tighter fiscal policy, there's no doubt that will manifest itself with lower and lower rates, because the economy is not going to respond to that. Do you agree?
In the realm of what anyone would consider conventional, yeah, I think that's probably correct. I think if the ECB or, for instance, the BOJ went out and just started buying stuff, they could definitely generate inflation if they wanted to. Now, whether that would be a good idea or not is another question entirely, and it's certainly not on the table for either of those two economies at this point. If they're just going to keep cutting rates further into negative territory and keep hammering the term premium via successive rounds of QE, then yeah, I mean, there's only so much that yields can rise based on positioning or other factors. With respect to the uptick we've seen in Bund yields since the lows, which I think were in August, if I'm remembering correctly off the top of my head, right. Then that move higher can reflect the fact that move downwards in yield was carried away. And just because we're making some higher highs and lower lows now, or higher lows now, doesn't mean that we're on the cusp of a huge upward move in Bund yields as Germans finally decide to do some deficit spending and transfer some more resources from the export sector to the household sector. I don't think we're there yet. Like you mentioned, cyclically adjusted primary balance. Well, primary balances are a great way to look at government spending and how loose or tight the fiscal position actually is. The problem is if you start doing cyclical adjustments, then you can do all sorts of funky stuff to make it look good or bad or however you want to make it look. So I'm pretty skeptical. There's certainly room for Germany to run at the very least a balanced budget, and I don't see that as anyone's baseline forecast right now. So if you're talking about an economy as big and stable as Germany with the debt load that they currently carry, with the outlook for their activity, and they're trying to run persistent surpluses, like I don't care how small, what the tinkering around the margin is, that's not going to get it done. And so, I don't see a fundamental shift in how the Europeans think about deficits and to the detriment of people that live in Europe, honestly.
All right, George. I'm gonna jump in here, Kev.
Okay, I'll let you have
one. So, George, let's translate your bigger narrative and thesis into some core macro views and that are tradable. Like, what's with the way that you look at the macro world? Where do you stand on things like, for instance, where the next major trend of the U.S. dollar is heading, or what are some of the other big macro calls you have that you think will emerge based upon the way you look at the world here?
So I think long-term rates in the U.S. are still far too low. I think the yield curve is still far too flat. I hesitate to have too strong of a view around the movement of short-term rates over the next year or something like that. But I do think that given the fundamental demographic backdrop for the United States economy, given the fact that debt levels are still very low or still falling, they're not very low on a long-term basis, but they're definitely falling, and debt carrying costs are still very low on a long-term basis, especially for consumers. It's really hard to look at the U.S. economy and say, okay, well, this is vulnerable to a large shock, and therefore, we've got risk of an impending recession. I mean, the Fed has been incredibly aggressive this cycle in a way that it hasn't been in the last three major cycles in terms of heading off recession. And if you're going to have a Fed doing that, like pulling the trigger early to try and avoid recession, first off, that's good public policy. But second off, that should justify a different perspective around the risk premium on inflation than you had when your last three recessions have all come because the Fed's been too aggressive snuffing out growth when it's gotten nervous about inflation, right? If the Fed is going to be in the long term oriented towards being easy and making sure that the expansion continues, acting as appropriate, to quote Clarita from today, then you have to have a very different perspective on risk premiums for, something like 2s 10s, 2s 30s, 5s 10s, or 5s 30s than you would in a world where you're actually worried about the Fed cranking up real overnight rates to the point where they invert the curve and create a recession. The current inversion of the yield curve we've just experienced has been totally different from the three inversions that preceded the last three recessions. And people say, oh, well, you can't say it's different this time because it's never different this time. Well, it actually is different this time. And the reason it's different this time is because as the curve has inverted into Q3 of this year, it's done so with interest rates at the front end of the curve falling, right? So all rates have come down. Rates at the front end of the curve have not fallen as fast as long-term rates, and so the curve has inverted, but rates have come down. That didn't happen in the prelude to the last three recessions. In all three of those recessions, what happened was the Fed raised short-term interest rates and kept pushing short-term interest rates up until they moved higher than long-term interest rates and created problems for the financial sector, created a situation where bond buyers had to step in because they were afraid that real rates had gotten too high, and ultimately created a recession. So this inversion has been different. And just fundamentally, if you've got a Fed that's on avalanche patrol, to borrow my friend Mark Dow's term, that's looking for risks, that's trying not to snuff out the expansion as opposed to that's constantly worried about inflation, then you should have government bonds with a much, much, much higher risk premium relative, for long-term bonds relative to short-term bonds, because at some point the Fed is going to overshoot and you're going to see inflation. And that wouldn't necessarily be the end of the world, but for government bond curves, it's hard to look at where things currently stand in terms of the term structure and say, oh yeah, that makes sense for a Fed that's demonstrated its willingness to be much easier than it has been historically when risks start to rise.
So would you also agree that not only should we see a steeper bond curve, but we should also see inflation break-evens take off?
Yeah, the inflation break-even market is just, I'm sure, Kevin, you're familiar with my rants about break-evens and how ridiculous they are as an instrument. These things, because of how seasonal oil prices are and how that translates into the non-seasonally adjusted CPI, which inflation break-evens price off of, you tend to see very, very large movements based on the time of the year that you're in and the level of oil prices, because dealer desks hedge their TIPS portfolios and their break-evens portfolios with spot or near-term futures for gasoline and WTI or Brent. So what you basically turn the break-even market into is an oil derivative. You cannot look at the break-even market that is using short-term oil prices to hedge risk, up and down in terms of the implied inflation rate, and conclude that that is a reasonable expectation for the movement of inflation over the next decade or half decade or whatever your term is. That's doubly true when you start looking at implied forwards. So for instance, 5-year gets cited all the time, where you're basically in a leverage steepener and extra sensitive to movements in spot oil prices. I've been talking about this for years. A number of other people have as well. And it's very frustrating to see so much emphasis placed on break-evens. Regardless, you've got 10-year break-evens trading in the 1.6 area right now, if my memory serves correctly. That's just not going to fly in an economy where realized inflation has been substantially higher than that of late, and almost certainly will be with a 2% inflation target for PCE as opposed to CPI from the Fed. And again, a Fed that's demonstrating that it really wants to meet those targets, even if it hasn't been able to very effectively hit them perfectly. They want to. You get an extra 0.3% basically between PCE and CPI. So if the Fed is hitting its inflation target, it should be about 2.3% year over year headline CPI year in, year out over the next decade. If they're a little bit short, let's call it 2% CPI year in, year out over the next decade. That leaves no risk premium whatsoever, none, for a large spike in inflation. And I don't think that's likely to happen, but it's certainly something that markets tend to be worried about. So to me, 1.6% break-even inflation is just nuts. I mean, it doesn't make sense unless you're assuming that the Fed is completely going to fall flat and that the whole edifice upon which modern United States monetary policy is built on is just going to collapse.
Okay, great stuff, George. That was a great rant, buddy. I love it. For those who want to kind of hear more of your rants and see why you think inflation break-evens are mispriced or not something you should follow, where can people find you?
So I am on Twitter. I'm at Pearkes on Twitter. You can also check out bespokepremium.com. That's Bespoke Investment Group's website. You can check out a free trial there or just browse through our blog. Bespoke Invest is our firm's Twitter account. We also have a podcast that's totally free and a bunch of goodies over on the website. So you can head over there or follow me on Twitter.
I highly recommend it. I think George is one of the nicest guys on Twitter, and I think that has to do with the fact that even though he's living in America, he's actually a fellow Canadian. For those who want to learn more about George's background, make sure you stick around for the after hours. Thanks for joining us, George.
Thanks, guys.